Hey guys, welcome back to another video. So today I just funded the Robinhood account again, and I'm gonna start doing more. Sorry about that. That's my dog playing with his toy. Trying to do more videos on Robinhood here because lately I have not been doing any more Robinhood videos. So I just funded the account with $1,000, and today I'm gonna show you how to do a cash secure put and how you can profit from it. Now, a cash secure put is basically you're putting your money up as collateral, so you don't own any shares yet. Now, you run the risk of getting assigned of owning the shares at a specific price point between a certain amount of time. And I'm going to walk you through doing it right now and how you can actually benefit from this. Now, let's say there's a stock out there that you're looking to buy. Okay, so here I'm going to use NEO as an example. I'm looking to buy NEO already. Now, NEO is trending at $3.69 per share right now. I'm looking to buy 200 shares of NEO. But instead of paying $3.68 for each share right now, I want to try to get it at a cheaper price, maybe. Now, I can wait for the price of the stock to drop and then buy at the dip, or the other thing that you can do is sell a cash secure put. You go under trade options. Now, depending on the expiration date up here that you see up here, the further out you go, the more money you're going to get paid up front in premium. So I like to do maybe weekly, monthly ones on NEO. Now you can go further out, but that's giving the buyer more time. Now, I want to do, let's say, May 22nd, right? And you see all these different combinations again. We're going to sell a put, a cash secure put, because we're putting money as collateral. Now, you can sell naked puts on other brokerages, but on Robinhood, it's basically a cash secure put. So we want to pay something right around maybe $3.50. I'm okay with paying $3.50 per share. Well, what's a great thing about this is, well, first of all, I'm going to get it at a cheaper price if I get assigned the shares. I'm already looking to buy it anyway, but right now it's trending a little bit higher. So by selling this put option, one contract represents 100 shares of the stock. And to take on that obligation, on that risk, what other people call risk, I put that in quotes. We're going to get paid premium, money up front for taking on that so-called risk. Now, again, I only do it on stocks that I'm looking to buy already. That's why, what other people see as risks, I see it as a good thing and getting paid to do it. So let's say we want to sell, well, I want to buy 200 shares of it. So remember, one contract represents 100 shares of the stock. So if we're taking on the obligation to buy NEO at $3.50, if it drops below $3.50 between now and May 22nd, that means we would have to put $700 as collateral. So in total, we're going to do two contracts then. So we're going to get paid money up front, which is $32 right there. Now you can put a limit, on the bid and the ask. Now the spread is $15 on the bid. The ask is 17. So we'll leave it in the middle at 16. Review. See the collateral right there? 700. That's how much money is going to be tied up in our account between now and May 22nd. Now, of course, you can always get out of the contract, and I'm going to show you how right now if you choose to. Now, you see right here, you are agreeing to buy 200 shares of NEO at $3.50 per share on or before May 22nd. If you are not asked to buy the NEO by then, the shares of NEO, you'll keep your full collateral and the full $32 credit. So let's swipe up and see if we get filled. Now, hopefully we get filled because we put the bid right in between. I mean, we can always lower the bid and it just get filled. It's like $1 difference. But let's go ahead and do that so we can actually get filled and continue with the video. So let's put the bid the 15 cents. 0.15, there you go. So we would get $30, and we're doing it for the purpose of just continuing the video. It's not really a big deal, $2. So swipe up. There you go. So we just sold 2 contracts. Now let's go back to the our page. Now we put up $700 as collateral, which is tied up right now. You can see it right here. So even if we go on our buying power, we have the rest, which is $329.98. We got credited $30. Now what happens now? Basically, if NEO drops below $3.50 between now and May 22nd, most likely we're going to get what's called assigned to buy the shares at $3.50. So if it goes below, let's say it goes to $3.40, right? So because of this contract, and if we get assigned, we're going to have to pay $3.50. But remember, we got paid for taking on this obligation. And a minute ago, we were willing to buy NEO at what it was currently trending, which is right now $3.68 per share. So doing it this way, not only are we getting a discount on something we wanted to buy already, but on top of it, we're getting paid money up front, credited into our account for taking on this obligation. So you're getting exactly what you wanted, the shares that you wanted, at a cheaper price now, instead of waiting and not getting paid for it. And you're basically making money off of it. Now, what happens if NEO starts trending up? Basically, it just goes up. Now, you can do one of two things. Let the option expire worthless. So you ended up basically making those $30 for simply putting your money up as collateral, and you never even bought the shares. So this is one way of getting paid to not buy stock, in other words. Now, the other thing that you can do is simply buy the option back. Now, the higher the price on NEO, if it starts going higher, the cheaper this contract is going to be worth, because now the chances of you getting assigned to buy the shares are going to be slim. So now this same contract that you got paid $30 for, it's now going to be worth a lot less. So using those $30, you can simply buy yourself out of the contract before expiration and wipe your hands clean and move on to the next trade. Now, what happens if you do get assigned to buy the shares? Well, that's a great thing about it. You wanted to buy the shares anyway, right? Now, you can either wait, depending on your strategy, for the price of the stock to go back up, maybe a swing trade, or if you want to do like me, I usually turn around and sell a covered call. So now let's say we have the shares at $3.50. Now this price will vary, of course. Now let's say we want to go into May 29th, and this time we're going to sell, the combinations again, sell a call. Now we're using those shares as collateral. Now, because we have 200 shares, that means we can sell 2 covered call contracts. So let's say now we want to sell them at $4. Now we want to sell them a little bit more than what we paid for. So currently, this is how much you would get paid. This is our real time. Now, at the time of assignment, it might be different, of course. But let's say you want to sell them at $4 per share. And for 2 contracts, because you have 200 shares, now you would get paid $36 for selling them at a higher price if the price of the stock goes above $4. So if you've seen all the other videos that I do on covered calls, you would understand how that works basically. But this is a great way to get some income going on, maybe stocks that you're already looking to buy anyway. Sell some cash secure puts, get some money paid up from front instead of simply waiting for the stock to drop. And if you do get assigned, turn around and sell some covered calls. Now, in my opinion, this is a great strategy, a safer strategy to kind of grow your account little by little with not taking on that much risk. And selling cash secure puts, it's a great way, in my opinion, to get into those stocks that you're looking to buy already and get paid for it. So this is just a video that I wanted to do real quick for you guys on how to sell cash secure puts, get paid for it, and make money while doing it. So, it doesn't really take a lot of money to do this, but you can actually see the potential on doing this. But anyway, thank you very much for watching, guys. And until then, I'll see you guys on the next video.